Hello everyone, welcome to chapter 24 of CPI. In this chapter, we'll be discussing the details and intricacies of turtle soup entries. Now, I've already made a chapter about it, but that one only covered the basic and intermediate details. So in this particular chapter, we will be diving into the advanced and the more deeper intricacies and details of this topic. And by the end of this chapter, you'll not only be equipped with enough knowledge about how to get precise and accurate entries, right, somewhat similar to mine and Romeo, but also you would be capable of knowing how to properly integrate it with the other ICT and CRT concepts. We will discuss how to frame entries, how to put stop losses, and moreover how to integrate it accurately. So without any further delay, let's get right into the video. So first of all, we'll start off with a bit of introduction to it. Now, some of you might already be familiar with this part, but let's remind it one more time so we are fully up to date on every single detail, right, including the basics. Because you know the basics are the foundation of any concept, right, and it lays down the base. That's why you should never take them for granted, but instead you should treat it with as much respect and importance as the other concepts. Because no matter how much you try to furnish or polish a building, if the base isn't strong, it will fall in a matter of time, right? It will be vulnerable, which is something you don't want. Now, someone could also argue that the base is even more stronger than the building itself, because without it, you know that the building cannot exist. So let's finally get into the details of turtle soup. Now, at its core, a turtle soup entry is an entry that focuses on the concept of a liquidity hunt or a liquidity purge, right? Now, you know what a liquidity hunt or liquidity purge is. It's basically when the market intentionally triggers the stop losses of retail traders, right? Which often breaches significant swing high or lows, and then after that we reverses in the opposite direction. That's what basically liquidity hunt is, right? We know that retail trader typically place their stop losses just above uh, highs or resistance or key levels, and below support level or key levels, or below lows, right? And we know that the smart money take advantage of this by pushing price above or below these zones, by rejecting above or below it to grab liquidity. And once the liquidity is hunted, grabbed, or manipulated, the market reverses and moves in the opposite direction, right? So basically, turtle soup entries allows you to join the move after the liquidity purge, which helps you position yourself on the right side of the market, along with the market makers in the institutions, right? It's like following the steps of the institutional player instead of actually getting caught in their traps. That's what the point of turtle soup entries is. Now you might be wondering, why is turtle soup the most advanced entry method, right? Because this method requires a deep understanding of market behavior, liquidity zones, and timing, right? You need to be fairly and well equipped and well versed with all of these aspects, knowledge about all of these aspects about the market behavior, liquidity zones, and timing before you are able and you are capable enough to have precise and accurate entries consistently, right? Because turtle soup isn't just about spotting patterns, right? It's about understanding why the market behaves a certain way around key levels, and why is this liquidity being purged, right? You are anticipating manipulation and then capitalizing on the reversal, which require precise analysis, execution, and also at the same time some level of intuition and experience as well. Now let's talk about why is turtle soup so effective. So number one, it capitalizes on the retail mistakes, right? Now most retail traders relies on conventional setups like support, resistance, indicators, and trend lines, right? They place their stop loss in predictable areas, which become high or a random low, and when that high low is taken, they take an entry immediately and straight away, which eventually leads them to their stop loss being hunted, and then price reverses on them, and then they wonder what happened, right? That's why you never rush into a starter soup entry, but instead you're going to let the move in, because after a liquidity hunt, the market often experiences momentum driven spikes that can easily take out early turtle soup entries and traders, right? So your job is to wait for the move to exhaust and end, and then for price to provide confirmation of a reversal into the prior range, and then look for an entry. And you're going to look for wicks or sharp rejection at key levels, right? Or maybe you could look for a market structure shift on the lower time frame that gives you a confirmation, and then you can take an entry after that. Now, to refine your data soup entries, you must combine key level standard deviations and key times in a logical way. For example, if the market takes out a daily low during the London kill zone and it aligns with a 2.5 standard deviation level of the Asian range, right? You're going to wait for a confirmation, and then you're going to enter, right? And the, all of these confluences together significantly increases your position. You'll see multiple example of this in a minute, so don't worry about that. And then last but not least, the most important part is adaptability. One of the most critical skills in refining turtle soup entries is adaptability, right? Because we know that every day is different, right? Some days liquidity hunts might align perfectly with key levels and standard deviations. Other days the market might create new scenarios where you need to adjust your framework, right? And you're going to use your chart time, your experience in backtesting data to understand how different elements interact in various conditions and different market conditions. And you're going to make sure that you never force a trade idea if the setup does not meet your criteria, right? Because sometimes sitting out is the best decision. And to ensure you're entering with precision, you're going to follow the following logic based checklist. First of all, liquidity hunt, you're going to wait for the high low to be taken in the move to exhaust. And number two, key levels and standard deviations. You're going to align your chosen key levels with standard deviation zones to create confluence. Number three, key times. Make sure that the setup occur at a key time, such as a kill zone or a key macro. And number four, confirmation. You're going to look for a rejection of wicks, shift in market structure, or lower time frame setups before that you can use to place your stop loss, and how to integrate them with each other for the best results. Now, ways to put your stop loss are the following. First of all, higher time frame key level. For example, let's say uh, there is a swing low, right? Just above a higher time frame discount key level. So what you're going to do is you're going to put your entry once the swing low is taken and the high time frame discount key level is tested, and then maybe you could put your stop loss below the high time frame key level. That could be either in the form of a order block or a fair value gap, or maybe a breaker block, right? That's one of the ways that you can put your stop loss, right? solid edge in good risk management, you can still come out ahead, right? That's what it takes to actually succeed in trading, not snapper entries, right? And don't get caught up in the fantasy of nailing the absolute best entry, right? It's unnecessary, and honestly, it's impractical most of the time, right? You don't need point will only lead to frustration in overtrading, right? What matter more is that you are entering with the market's momentum or structure in your favor. You are managing risk effectively so that even if your entry isn't perfect, your edge still plays out over time because you know how to manage your risk. Number three, focus on what you truly need, right? Instead of obsessing over perfect entries, shift your focus on what really drives success in trading, right? Which is a proven edge, right? Your edge is what gives you a statistical advantage over the market, whether it's a strategy like turtle soup or something else. A proven edge is what keeps you profitable over the long run, not snapper entries, right? You need to be aware of all the variables, right? You're going to make sure that you stay vigilant about all the key variables that influences your trades, which are market context, timing, key level, and risk management, right? And being aware of these factors help you make better decisions and helps you avoid unnecessary mistakes. The next thing that you're going to do is you're going to check your motivation, right? Here is an over the long term instead of having flashy setups and flashy execution that does not serve you any purpose in the long run. Moving on, here in this slide, I'm going to explain this step-by-step approach to you on how you can approach turtle soup entries. fair value gap, which is our 4-hour higher time frame key level, and just below that high we have this 4-hour candle range, right? And that is a 4-hour candle range because it formed at a key time, right? So that is our CRT, and we're going to use that to frame entries on the lower time frame. And on the left we've got the lower time frame, and you can see the first one, that is the CBDR or the central bank dealers range. And then along with that we also have the second gray box, which is the Asian range, and these are basically the means. And what we're going to do is we're going to plot out the standard deviations of these means, and you can see that we have these different standard deviation levels, which aligns with the higher time frame candle range or CRT. You can see that the 2.5 in the 2 standard deviation zone of the CBDR aligns with that candle range high, and then for the Asian range we have the 2 and 2.5 standard deviation level, which aligns with each other, align with the other standard deviation level. And you can see that by combining these key levels, these standard deviation zones, and the higher time frame context and narrative, you can see that we can take an entry right there at those standard deviation levels once price takes out the candle range, and then we can frame an entry there. Now let's move on to the next slide. And right here you can see that we took our entry at the combined zone of the 2.5 standard deviation level, which is just above the higher time frame candle range high, right? And for our stop loss, we put our stop loss at the 3 standard deviation level, because we know that is a protected zone, because price is already expanded enough to the 2.5 level, and it all happened at a key time. So more often than that, price is going to reject explosively off of there instead of moving above even more. And you can see we had a pretty good entry there. We framed an entry based on the higher time frame CRT, and that CRT was formed just below the higher time frame key level, the FVG and the high. And once that high was taken, the candle range was purged. We framed an entry there, and our entry was refined further to the standard deviation level of the Asian range in the CBDR, and the stop loss was placed by the standard deviation protocol, which is that we put it at the standard deviation 3 zone or level, and then we targeted the candle range low. That is our entry. Moving on to the next slide. Right here you can see that we've got another naked chart. Right here we've got this price section. On the right we've got the lower time frame price section, and on the left we've got the higher time frame price section. What we're going to do is we're going to plot out and annotate the relevant key levels, candle ranges, and standard deviation level, and then we're going to see how we would have framed our entry in this case. So right here you can see that our high time frame liquidity is higher, right? And we've got this order block, higher time frame order block, and right there we also have this higher time frame candle range just above the order block, right? And on the lower time frame price section you can see that we have the Asian range, and also you can see this manipulation leg as well. With this manipulation leg we took out this high, so we can also use this manipulation leg to mark out other standard deviation levels as well, relevant standard deviation level, where we could look for our entry setups or entries, Delta Soup entries. So you can see what price did is came down lower, took out the higher time frame candle range, and tested the higher time frame key level, which in this case is the order block. And you can see also we had this mini turtle soup right here, and that turtle soup happened to perfectly align with the 2.5 standard deviation level of the manipulation leg, and also with the 3 standard deviation level of the Asian range. So what we would have done in this case is put our entry at the 2.5 standard deviation level, or after the turtle soup happened, right, on the lower time frame. And for entry we would have put our entry at the 3 standard deviation level of the manipulation leg. So let's see how we would have taken our entry. And right here you can see the entry was taken right after the turtle soup, and we took it right away because we didn't need to refine it further, because it already matched with the standard deviation levels beforehand. So the only thing that was left is for us to place and put our stop loss, which happened to be at the standard deviation 3 level of the manipulation leg. And this is exactly how you're going to frame your entries Refine your entries and place your stop loss based on standard deviations, key levels, and turtle soup entries. This is how you do it.